Is the current tightness in U.S. credit spreads an indication of economic complacency? Well, U.S. corporate credit spreads are the measure of the premium corporations must pay in interest over the same duration U.S. Treasuries. The spread has historically been a glimpse into the financial world's view of coming economic conditions. When the spread widens, it's often an indication that the market believes that tough economic times are ahead and that there's more risk in owning corporate debt. Conversely, when that spread is tight, it generally means that the market feels risks are low and that the reach for higher yield is justified. Now, there are some secondary drivers of the spread that may explain the current historic tightness. Excess monetary liquidity in the system can, at times, fuel an inorganic reach for yield. This driver should be considered relative to the explosive growth in M2 money supply that's occurred since 2020 and continues today. Now, there are a couple different measures that are looked at in order to determine current risk appetite in corporate spreads. The two most relevant are, 1, the spread against investment-grade corporates, and 2, the spread against high yield. Theoretically, economic stress should show itself in the high yield spreads first, because those are obviously the more vulnerable companies. Now, interestingly, beginning in late September of 2024 through February of 2025, both measures have moved to levels of tightness not seen since before the financial crisis. Is it a coincidence that late September was also when the Fed embarked on its highly anticipated easing cycle? Probably not. It appears that the market took that as a signal that the Fed was keenly concerned with any coming economic weakness. Now, in the past, trading credit spreads was a cumbersome task mostly available to institutional traders, but that's changed. CME Group recently launched 3 credit spread products which settle to the core